Hi, everyone. I'm Brian Howard, ACEEE State Policy Program Director. I wanted to take a moment to welcome everybody back to day 2 of the 2021 Energy Efficiency Finance Forum. I hope you found yesterday's keynote with Jigar Shah and the plenary discussion as timely and interesting as I did. And if you participated in the Energy Efficiency Financing 101 workshops, I hope you found your participation rewarding and the information shared beneficial to your work. After you attend the live webcast today, please complete the Finance Forum survey linked in the Engagement Hub webpage. The information gathered from the survey responses is incredibly important in developing the format and program of next year's Finance Forum, which will be held in White Plains, New York on May 23rd through 25th. Today, you'll have the opportunity to participate in 3 concurrent sessions being presented live today. To avoid any fear of missing out, any session you miss will be available on demand or for on-demand viewing within the next few days. I'd like to now turn over the time to Stefan Sampras, my colleague with ACEEE, who will be the moderator for financing energy efficiency in low to moderate income and affordable multifamily housing sessions. Stefan?
All righty, thanks, Brian. So hi, everyone. And thank you again for attending today's webcast. Again, this webcast, just so you make sure you're in the right room, is financing efficiency in low to moderate income and affordable multifamily housing. As Brian mentioned, my name is Stefan Sampras. I work with the American Council for Energy Efficiency. And I'm the moderator for this session. So we're going to start this session with just a few kind of routine housekeeping announcements. Then we'll quickly move on to our speakers, followed by, and of course, there'll be some time for questions and answers after. So a few things to remember. As a reminder, your screen is customizable, utilizing the various widgets found at the bottom of your screen. Presentations can be downloaded as PDFs for the resource list in the menu. Attendees are in listen-only mode, but you can submit questions through the Q&A box anytime during the webcast. Presenters will be answering questions following all the presentations today, and I'll keep a watch out for those. All webcasts will be available for on-demand viewing within a few days. Brian mentioned that. So this is also important to know. Zoom discussion rooms will be open at the end of the webcast to continue the conversation here and allow for additional questions. Particularly, this allows you an opportunity to kind of engage more directly, face-to-face, or just ask your question or have a conversation directly with our speakers. So it'd be really great to have you join that. Click on the Zoom widget on the bottom menu or download the daily Zoom link PDF that's available on the Engagement Hub to access that. And a couple last things here. Please be sure to complete the evaluation form after your last webcast and receive a $25 credit towards next year's Finance Forum event in 2022. Your feedback is particularly helpful for us here at ACEEE in planning for future Finance Forums. And lastly, we want to thank our sponsors and partners for their support of the Finance Forum. All right, and so now I would like to introduce our distinguished panel of speakers. They are Candice Marie Dauphin from Stop Waste, Rachel Cluett from Fannie Mae, and Carrie O'Neill from Inclusive Prosperity Capital. So we'll start with our first speaker, Candice. So a little background on Candice. So Candice Marie Dauphin is a program manager at Stop Waste, where she manages BayREN's multifamily energy efficiency and finance programs, and works with stakeholders to drive the acceleration of energy retrofits in the multifamily sector and broaden their benefits. Prior to working at Stop Waste, Candice was a project coordinator at an environmental nonprofit, freelance energy policy writer, and a bank examiner at the Federal Reserve Bank of Cleveland. She holds a bachelor's degree in economics from Kent State University and a master's in energy and environmental policy from the University of Delaware. So with that, I will turn it over to Candice, and we'll get started with her presentation. Candice, you there?
Yes, thank you, Stefan, for that introduction. And with that, I am going to jump right in. So today I'll start with a quick overview of BayREN, which is the program administrator for the financing offerings I'm going to be covering today. And then we'll chronologically walk through our multifamily financing journey. So what we've learned along the way and how we're choosing to respond to what we've learned. So the BayREN, or the Bay Area Regional Energy Network, is a collaboration between the 9 counties that make up the San Francisco Bay Area. It supports the state in reaching its climate goals through implementing energy savings programs. Stop Waste, my employer, is a public agency that represents Alameda County in that collaboration, and it manages the multifamily sector programs on behalf of all 9 counties. So in addition to the multifamily financing programs I'll be discussing today, BayREN also administers a suite of single-family programs, a multifamily rebate program, and codes and standards, small commercial, and on-bill tariff water savings programs. So BayREN received authorization to launch its first multifamily financing offering, the Bay Area Multifamily Capital Advance Pilot, or BAMCAP, in September of 2013. We contracted with Wisconsin Energy Conservation Corporation, which is now Slipstream, to serve as financing experts and recruit lenders, and launched in the spring of 2014. BAMCAP worked with participating lenders and supplied up to 50% of out-of-pocket costs of an energy efficiency work at 0% interest. So it was an interest rate buy-down program. And to cover administrative costs, participating lenders set the minimum loan requirement at $100,000. BAMCAP leveraged participating lender processes, which simplified BayREN's administrative role. And we leveraged the 2 multifamily rebate programs in the region, our own, which is known as Bambi, and that of the local investor-owned utility, PG&E. And this allowed for streamlined qualification and quality assurance of projects. So the program was actively marketed for 4 years, and over that time we recruited 6 participating lenders. 2 of them specialize in affordable housing and 1 in HOA and nonprofit lending. So 11 projects completed in the first few years, and 8 of these were affordable, and the remaining 3 were HOAs. These project types are a reflection of the kind of participating lenders that we were able to recruit. And altogether, we loaned out $2.3 million in program capital, leveraging about $9.7 million in private capital. And our last project was completed in 2018. So what did we learn? It's no surprise that lower interest rates were attractive to customers. Leveraging private capital allowed us to stretch program capital dollars a lot further. Engaging with lenders through a model like this is a good way to broaden awareness of energy efficiency in the financial services industry. And finally, we were able to extend the loan terms up to the average weighted useful life of the measures installed, so borrowers had the opportunity to lower their monthly payments. There were definitely some limitations to this model. The one that seemed to be the biggest barrier was the request from lenders to set loan minimums at $100,000. They were concerned that loans under that amount wouldn't be large enough to justify the administrative costs of making the loan. And yet, most of the financing need that arose through running our rebate program was from smaller projects. So this restricted us from being able to serve the segment with the highest financing demand. Lenders were also concerned about the limited pool of program capital we were able to bring to the table and restricting growth. So for this reason, many didn't widely market the program. And because the program used ratepayer funding, only 30% of the loan amount could go to non-energy efficiency measures, and none of it could go to generation projects such as solar PV. We heard through our lender engagement that programs that finance energy and non-energy improvements would have more uptake. So this product was pretty straightforward for larger developers who have staff dedicated to project development, but it was harder to get owners of smaller and medium-sized qualifying projects to the finish line. So we decided to sunset the BAMCAP program due to waning interest, yet at the same time, through running our rebate program, we knew that there was demand for financing. We just couldn't meet it with our offering. We wanted to try out another design based on what we learned, but before doing so, we wanted to see if we could meet financing demand with what was already on the market. So we developed the lender referral service, which connected multifamily property owners interested in financing to available products on the market. In 2018, we worked with our financing consultant, Slipstream, to collect a list of institutions and products that could be used for multifamily energy efficiency upgrades and offered them as options for rebate program participants. These products included equipment loans and leases, on-bill financing, an ESCO-type product for deed-restricted affordable properties, and small business loans. In addition to serving large projects, several of these products could finance smaller and medium-sized projects. So after 3 years of receiving interest and engaging more than 30 projects and only being able to make 2 matches that resulted in signed loan agreements, we figured it was time to take stock of the lessons learned and see if we could create something to meet the demand that we were seeing in this sector. As for the lessons learned from running the lender referral service, the benefits are kind of theoretical, as they weren't really strong enough to outweigh the challenges, which were very real. Nevertheless, they included the opportunity to scale, as we weren't limited by program capital constraints. We were able to offer loans as low as $2,500, so a much broader range of loan amounts. In the multifamily sector, it's important to avoid conflicts with primary financing, and we were able to connect people with options such as on-bill, equipment leases, and ESCO-type products where this wasn't an issue. And depending on the product, some loan decisions would have been rapid, but because some weren't, we actually did lose a couple projects. While we didn't get to see most of the benefits that we anticipated, we experienced the drawbacks firsthand. It's not easy to convince property owners to install energy efficiency improvements, especially when the tenants are experiencing the savings. Paying interest on financing for a project in this scenario is even harder. Products with market level interest rates were pretty much a non-starter. When trying to engage lenders about the interest in financing energy efficiency upgrades, a few felt constrained by the fact that appraisers and secondary markets don't consider the value of energy efficiency savings in their evaluation. Another drawback was that the part of the sector that had the most need, owners of smaller properties, which is often where we see naturally occurring affordable housing, often have high debt ratio or lack credit history. And finally, many of the lenders we wanted to engage wanted to see a big pipeline of projects before they were willing to work with us. And we weren't able to provide a large pipeline without the right products, so we had a bit of a chicken and egg situation. So I'm going to skip through the next 2 slides for the sake of time. So we hit quite a few bumps along the road, and we got, pretty nice volume in the beginning, but it stopped just after a couple of years. So why continue to pursue financing? A few reasons. We wanted to find a way to make sure energy efficiency upgrades continued to happen once rebates inevitably start to phase out. We want to make sure that equity priority populations, such as naturally occurring affordable housing owners, can cover the out-of-pocket costs that may be needed to access rebates. We want to be able to make a meaningful impact in the lives of our community members in ways that improve health, resilience, and the pace of emissions reductions. And we need to think creatively about directing resources to those causes in order to have any significant effect. And finally, part of our charge as a government-led regional energy network is to pilot programs that can be part of the state's toolbox in meeting its energy savings goals, especially for populations that have not been well served by energy programs in the past. So after having some time to reflect on our lessons learned, completing a market study, surveys, and several rounds of stakeholder interviews, we decided on something small and simple, a direct revolving loan pilot tailored for the multifamily sector. Unlike Bayron's previous financing offering, BAMCAP, this iteration will be piloted solely with program capital. The program plans to make the product available for all properties initially, but ultimately seeks to target measures for which energy and cost savings accrue to the tenant and for electrification measures. The little graph in the corner there shows that in our rebate program, tenant benefiting measures have been rejected at almost twice the rate of common area measures. So there's a substantial amount of savings potential there, and I hope we can start tapping into it. Funds from the loan pool would be used to issue financing for projects with out-of-pocket costs of between $5,000 and $50,000, so smaller projects. Bayron also aims to implement an efficient loan application approval and funding process, which are often barriers to customer participation. We'll offer a low interest rate of between 0 and 3%, and the loan term will be extended out to the weighted expected useful life, but with no prepayment penalty. The loan would have no lien requirements and instead will require personal guarantee from a member of the ownership entity. So restrictions imposed by a property's first mortgage, which often prevent property owners from taking on additional lien secured debt without approval by the mortgage lender, wouldn't be an issue. So we hope that by making the product easy to understand, it'll be accessible to a wider range of property owners, and also, while providing capital directly and independently of outside lenders, allows us to have greater flexibility, increased control of the loan process, and tighter alignment with our multifamily rebate program, Bambi. It also limits available capital, reduces the opportunity to scale, and locks us into an ongoing servicing requirement. And it also increases the program's exposure to default. We hope, though, that we can use this as a proof of concept, show that it has the potential to scale, and seek out new sources of funding to accelerate the pace and expand the reach of comprehensive energy efficiency upgrades for some of the most excluded project and measure types in an already complex multifamily sector. And that concludes my presentation.
All right, thanks so much, Candace. Again, just a reminder for all the folks in the audience, please feel free to, as we're going through these presentations, to put any questions you have in the Q&A box, and we'll make sure to address those at the end. But we'll go ahead and move on to our next presenter for now. All right, so our next speaker is Rachel Cluett, and give you a little bit about Rachel. So she is a program manager with Fannie Mae's Multifamily Green and Healthy Housing Financing business. In this role, she focuses on developing and implementing financing products to improve the health and stability of multifamily renters through investments in high-quality residential service provision, healthy design, and energy and water efficiency. Prior to joining Fannie Mae, Rachel was a senior research analyst at the American Council for an Energy Efficient Economy, where she conducted research on policies and programs to advance residential energy efficiency. Rachel holds a Master of Public Health degree from the Harvard T.H. Chan School of Public Health and a Bachelor of Science degree from Cornell University. So with that, I will turn it over to Rachel, and Rachel, you can take it from here.
All right, thanks, Stefan. Hi, everybody. Good to be here today. So I'm going to talk about Fannie Mae's Green and Healthy Housing Financing programs, where we are really coming at financing energy efficiency by integrating it into the standard mortgage financing process. Basically, encouraging multifamily property owners to incorporate efficiency upgrades into their standard mortgage loan, using mortgage proceeds to finance energy efficiency upgrades. So I want to start with just a quick kind of where Fannie Mae sits in the mortgage financing system. We are in the secondary mortgage market. So Fannie Mae does not originate mortgages directly, but we work with a network of lender partners that you see on the left there, who are basically delegated to originate mortgage loans that conform to Fannie Mae standards. Fannie Mae purchases those loans from lender partners and then securitizes them as MBS that are sold to a global investor base. The programs that I am talking about today are really all designed to fit into this framework. And the key to that is really to make the programs as simple, as streamlined as possible so that lender partners who aren't necessarily experts on energy efficiency can offer these options to multifamily borrowers when they're coming in seeking their mortgage financing for a property. So, high-level overview of what our program, what our team focuses on. All of these programs that we offer are really focused on what we call the triple bottom line, so creating positive environmental, social, and financial benefits. We have 3 different programs. I'm going to focus primarily on Green Rewards today, but I will touch on all 3. Green Rewards is our product that encourages property owners to make energy and water efficiency improvements and install solar PV at their properties when they're seeking mortgage financing. Green Building Certification is an incentive for properties that have already taken the initiative to incorporate efficiency into their project and have received a Green Building Certification. And then Healthy Housing Rewards, which we won't get into too much today, is a product that is specifically for our Capital A affordable business, so affordable loans that have rent and income restrictions in place at the property to keep units permanently affordable to tenants. This is to incentivize borrowers to make health-promoting design and operational improvements at properties and to provide high-quality resident services. So these programs are available to all multifamily properties, which we define as 5+ unit property. And then in terms of the affordability section that we're getting at with these products, they are available to all multifamily borrowers. Fannie Mae's regulator requires that in 2021, at least 50% of Fannie Mae's business is mission-driven affordable housing. So these programs are very much designed to include that portion of Fannie Mae's business, as well as the even more deeply affordable, kind of subsidized affordable and naturally occurring affordable. So the current scope of the program spans over 4,000 mortgage loans and $87 billion in green mortgage-backed security issuance as of the end of 2020. This doesn't include what we've done so far this year. And you can really see over time the participation and interest grow, really from a trickle in the early years, 2012, 2013, 2014. It was a handful of loans every year. This was not a familiar concept to our lender partners. To at its peak, about 40% of the overall multifamily MBS issuance in that given year. So we often get asked what happened in that 2017-2018 period to really make the volume explode. Part of it was lenders getting experience with the program, us kind of iterating on the tools and processes within the program to make it as streamlined and as clear as possible to lenders so that they, not being an energy expert, can still walk their borrower through how they can leverage the program to improve efficiency. And the other piece was favorable treatment of green mortgage loans at the time by Fannie Mae's regulator. So you'll see here this Fannie Mae Green MBS issuance. One of the things about the programs that we offer is the ability for us to bring into Fannie Mae a new base of investors that are really focused on investments that address climate change in some way, on ESG or environmental social governance. What we do for all the loans that are originated through the Green Building Certification Program and the Green Rewards Program, those are securitized as Green MBS. And they have ongoing disclosure of energy and water consumption at the property for investors. And that has really allowed Fannie Mae to continue to invest in this business. This also is really a critical part of Fannie Mae's overall ESG strategy as a company. So focusing on reducing the overall environmental impact of the assets that the company is financing, and also improving multifamily properties in a way that's reducing costs for tenants and also improving tenant spaces. So Green Rewards is really the key program for property owners that want to make energy and water efficiency improvements at refi, at acquisition of a property, or during supplemental mortgage financing. As a part of this program, we developed a standardized energy and water audit aligned with an ASHRAE Level 2 audit. And the key is that it can be completed in a standardized format that our lender partners know how to interpret, and also can be completed in a short time frame within the typical loan time frame, so that it does not slow the overall mortgage financing process. If addition of the energy audit means that you add another couple weeks or a month onto the overall process, and that's not going to work for a lot of borrowers who might be competing to acquire a property and need to get things in line quickly. So to qualify for green rewards, property owners get this standardized energy audit done. We call it a high performance building report. And then they select from that audit a package of measures that is projected to save the property at least 15% energy savings and an additional 15% energy or water savings. So by having that threshold, typically property owners are not only having to invest in improvements that are impacting their bottom line, but also really reaching into improvements that reduce tenant utility bills as well. Property owners then escrow the projected cost of the improvements at 125%, a little bit of a buffer to make sure they have the funds available to pay for the improvements, and then they commit to installing them within 12 months. They also commit to providing ongoing utility data on an annual basis to Fannie Mae, as well as a verification inspection on site to make sure that the efficiency measures are installed as initially specified. And then as a benefit, they get a lower interest rate for green rewards, as well as a free energy audit. We reimburse the cost of that report. And then I'll get into the mechanics of this in a minute, but they have the opportunity to gain additional loan proceeds based on the projected utility cost savings from the measures that will be installed. Borrowers can also leverage green rewards to invest in solar PV. Similar to the standardized audit that we developed for energy and water efficiency measures, we also have a technical solar assessment that's looking at really all aspects of the technical, legal, and financial aspects of installing a solar PV system, so that borrowers can really be armed with a complete understanding of what type of solar PV system is appropriate for their property, what size, so that as they negotiate with solar installers, they have a really good understanding of what's appropriate given the context of their property. So here's a snapshot of the standardized energy audit high performance building report, we call it, that an energy auditor completes for every green rewards deal. Basically, the borrower and lender work together, and this is probably a little small to see, but this is a list of the recommended energy and water efficiency measures, the projected tenant cost savings, the projected owner cost savings, as well as the projected cost to install each measure. So the idea is to really lay out this information in as clear, as simple as a way possible, so that a lender and borrower who are not energy efficiency experts can walk through this and understand what they need to do to both qualify for the program, to meet the minimum energy saving requirement, and also be able to incorporate the projected utility cost savings into the underwriting for the deal. So this Excel form is part of what was developed as kind of the standard process for green rewards. If you want to check it out, you can Google Fannie Mae Form 4099H. Maybe I can drop it in the chat after I'm done presenting. But the idea is really to get this information, the key information needed to make decisions about efficiency improvements upfront in a clear, easy to read format, so that a lender who's not familiar with energy auditing, or who just doesn't have the time to really dig through a report to fully understand it, has the information that they need up front and center. So I want to get into just an example of how green rewards can be used to leverage additional loan proceeds to pay for efficiency upgrades. So In a kind of standard Fannie Mae loan, the underwriting is typically based on the trailing 12 months of operations and income at the property, including the trailing 12 months of utility usage and expenses. So what this benefit allows a borrower to do is incorporate the forthcoming savings from the efficiency improvements that they have committed to install as part of the program into the underwriting. So in this example, deal, they have a net cash flow of $805,000. By being able to underwrite a portion of the projected utility savings, so $22,000, they can increase their underwritten net cash flow to $827,000. So that allows them to increase the maximum loan amount from $10 million to $10,275,000, while still staying in the required credit standards that the lender and Fannie Mae set forth. So we do give the owner utility savings a bit of a haircut. We allow for underwriting 75% of those projected savings, just to be conservative. But then we also do allow for a portion of resident projected savings to be underwritten, even though these are not accruing directly to the bottom line. We do this because it encourages investment in tenant spaces, and it also accounts for those secondary benefits that potentially will hit the bottom line of having more energy efficient spaces, leading to happier tenants with less turnover. So real quick, we also have a potential, we also have a green mortgage loan option for borrowers that have already invested in energy efficiency improvements. That's our green building certification preferential pricing. This pricing will reduce the interest rate of most loans. So properties that have built to one of the green building standards that we recognize can get a lower interest rate. What we do is basically look across the multifamily certifications available on the market every year to understand the anticipated energy and water savings from kind of national baseline standard building, and then use that analysis to inform the certifications we recognize. We wrote about this for ACEEE summer study last year, so we have a paper on that if you want to check it out further. But it's a wide range of different certifications that we include, including Passive House, different LEED certifications, Enterprise Green Communities, Energy Star for existing multifamily. There's really a range. The last thing I'll leave you with is just an example of a deeply affordable property where the borrower worked with their lender, Wells Fargo, to finance an acquisition. This was a property that was age restricted, so senior population. What the borrower did is they committed to include energy and water efficiency improvements into the larger renovation scope that they had planned after they acquired the property, as well as healthy design measures addressing indoor air quality at the building, creating kind of more outdoor space and walking space, and qualified for healthy housing rewards, and incorporated these improvements into their existing renovation scope. They were able to get a lower interest rate from Fannie Mae because of that, and the utility cost savings associated with investing in efficiency as well. So I think I'll kind of leave you with, this is a great opportunity really for getting borrowers to understand the value proposition for investing in energy efficiency by having that comprehensive energy audit in front of them at the time of financing, while they do have access to low-cost capital as part of their overall mortgage financing, integrate efficiency improvements into existing scopes of work, or just on top of what they were planning to do already. And I'll leave it at that. Thanks, everyone.
All right. Thanks, Rachel. And I'll just give one quick question that came up. It's sort of more of a clarifying question related to your presentation. Someone asked, would it be possible to give the link or name of the Excel file that you presented? I don't know if that would be, but.
Yeah, let me see if I can drop that in the chat. It's called Fannie Mae Form 4099H. It's our high performance building report standard for all Fannie Mae Green Rewards loans. But if you can't find it with that info, I'll try to drop it in the chat.
Okay, thanks, Rachel. Okay.
Yeah.
All right. So, and just one last reminder too, please don't forget to submit your questions. We'll get to those after our third presenter here. But coming up, we're going to hear from Carrie O'Neill. Carrie leads Inclusive Prosperity Capital, a not-for-profit investment fund that was spun out of the Connecticut Green Bank to scale up impact for underserved communities and underinvested markets across the country. Inclusive Prosperity Capital operates at the intersection of community development, clean energy finance, and climate impact with a collection of products and strategies that use an ecosystem approach to matching capital supply with project demand through mission-aligned partners on the ground. And with that, I will turn it over to Carrie. There you go, Carrie.
Great. Thanks. Thanks, everybody. Great to be here, and really great to be with Candace. And I really appreciated Candace's overview of the real challenges that we see in this market, and so on point with our experience as well. And great to be following Rachel, because so much of our work that we've done both at the Connecticut Green Bank and now as we spun out and working nationally at Inclusive Prosperity Capital, really working as complements to mortgage products and mortgage-based strategies. So I'm going to be talking about new investors that we're seeing coming into this space, and lenders and products in low to moderate income communities, with a focus on multifamily. And as you heard, we spun out of the Connecticut Green Bank a couple of years ago at the end of 2018. And we are focused on underserved markets, basically markets where we don't see capital easily flowing and where lenders are challenged to work at scale. Unlike Rachel's presentation, which is at scale, which is super exciting to see for our industry. And we define underserved markets in a couple of ways. Certainly low to moderate income communities, no doubt, but also credit challenged borrowers, whether that's consumers or commercial customers, also smaller deal sizes. So we have a somewhat expansive definition of underserved. And we have both investments that we make in our investment business, and then we also have services that we provide and program models that we can provide on the services side of the house. So as I mentioned, we focused on gaps, and so I'm going to be covering some examples of gaps where we've innovated some product approaches that we've then adapted more broadly. But I'm also going to be talking about partnerships and the way in which we use partnerships to get at scale and get at these difficult parts of the market. So first on the partnership side, so this would be on the deployment side of the house. How do we move capital into communities? This started at the Connecticut Green Bank, and so it's built into our DNA at Inclusive Prosperity Capital, is partnering deeply with folks who are on the ground and see the need, and where we can bring financing solutions to help them achieve their mission. So this could mean partnering with CDFIs or other financing authorities as originators and co-lenders. It could mean partnering with other green banks. Of course, we have still a very close relationship with the Connecticut Green Bank, but partnering with other green banks as well. I'm going to give an example of that. Really importantly, partnering with technology developers, or what we call platform originators. These are the new business models and new organizations that are forming to offer financing to a specific market, but they need capital solutions. Or it could be an efficiency technology developer or a solar developer. One of the things that we're very excited about related to affordable multifamily is the opportunity to work with housing portfolio owners to adapt some of our productized approaches to work within their business needs and their capital stack needs in kind of a dependable, reliable way where they could know what the process is going to be to work with us as a lender and green up a portfolio over time. And then, of course, we work with nonprofits who are trying to promote financing to their constituents. There are a couple of other, kind of exciting things on the radar screen too that I would just mention that I won't probably have time to talk about today, but we are also seeing interesting models related to affordable housing that are like virtual power plant models that one could imagine housing portfolio owners start to adapt as well. So let's get into the first example, and this would be on the new investor side of the house, as well as partnering models. So Inclusive Prosperity Capital, we are a financial intermediary, and our fund structure is attracting new investors into the affordable housing space and some of the other areas that we focus on, just because we provide a vehicle for investors to invest. And we're aggregating up the investments so an investor doesn't have to look at small deals, for instance. They can invest in us at the fund level, and we're aggregating up that investment. So very kind of importantly, we think of a blended capital stack as we capitalize our fund that has philanthropy and impact investment that really kickstarts and leverages other capital sources. And then we can layer on other mission-aligned impact investors and ultimately commercial capital and CRA capital. We're not at CRA yet. And then we've got things like capital grants and operating grants, program-related investments that kind of round out the picture and provide a multiplier effect. So it's exciting to see this collection of investors come together in a fund model that can focus on affordable multifamily. So on the foundation front, we have partners like the Kresge Foundation that's provided us with a large guarantee that allows us to unlock capital from senior lenders. One of the first and biggest examples of this is our partnership with New York Green Bank, who's provided a credit facility to IPC so that we can lend into these challenging markets to the benefit of New York State. We also have, of course, our founding partners with Connecticut Green Bank and the Department of Energy and Environmental Protection. So another example of kind of place-based investing. These are dollars that are focused on Connecticut, but are part of a broader fund structure and leveraging a larger infrastructure. And then we have folks like faith-based investors investing, like Mercy Investment Services, the Sisters of Mercy out of Kansas City. So kind of bringing all these pieces together allows us to have a blended capital rate that we can then deploy across our entire business line. So I'm going to move first into the first example of where we innovated a product, thinking about gaps specifically in the affordable housing market. And again, thinking about complements to mortgage financing, since there's great products that are available there. So this is both an example of partnering with another green bank, but it's also an example of a gap in the market that we identified in Connecticut, innovated a product at the Connecticut Green Bank, and now are taking to scale outside of Connecticut. So what we're doing with the DC Green Bank is we are partnering with them to support something that Mayor Bowser has shown great leadership on, passing a building energy performance standard for the city, for Washington, DC back in 2018. So this policy has requirements for building owners, And what the DC Green Bank recognized is that resources are needed in the market to help property owners comply with this policy. And pre-development financing, being able to pay for those pre-development activities, the design and engineering work that you need to do so that you can upgrade your building and comply with the policy, it's challenging to find resources for that. There's not enough grant resource to go around. This is something we saw in the Connecticut market as well. And so in the Connecticut market, where we saw a similar challenge, we partnered with a CDFI to design a pre-development loan product that would de-risk these pre-development activities. And it's designed to be paid back when the project moves to construction, either out of reserves if the property owner has them, or out of construction or permanent financing. And so this is a great example of identifying gaps in the market and enabling these upgrades to happen by covering these important pre-development costs, and then also furthering policy goals. So in the case of DC, a little bit of a carrot and a stick, right? You've got a policy, but now you've got a carrot out here. You've got a really great option to provide owners to move forward on the design work needed. So in this example, IPC has taken a product model, and we've partnered with the DC Green Bank. The DC Green Bank is bringing their own capital, so they're capitalized as a green bank. They're providing their own capital. And then we are partnered with DC Green Bank to underwrite and to administer the loan program, so do the servicing of it, because we're very familiar with it, and this is kind of a new area for the DC Green Bank. So that's an example of how we can partner, and we're working on similar models with the Philadelphia Energy Authority and Michigan Saves, and another CDFI in Florida called the Solar Energy Loan Fund, to bring this sort of product to their market, where the partner is really on the front lines in the market doing the origination work. Next, I want to talk about a permanent financing solution that's really meant to be a complement to the sort of lending that Rachel described, the mortgage lending. So the need that we saw in the Connecticut market, and we partnered with a CDFI, Capital for Change, to develop this, was a solution for mid-cycle upgrades. You're not at a capitalization event. You're not at acquisition. You're not doing a refi, but you got a need. You got a real need. It was also designed to address the complexity of affordable housing capital stacks, where you can't put additional mortgage secured debt on because of covenants or what have you. So we designed a product that would address those needs. And similar to what Candace spoke about, this is a lightly secured product. It's not mortgage secured debt. It's a UCC1 filing. There may be some corporate or personal guarantees depending on the underwriting. Importantly, we're underwriting to energy and operations and maintenance savings, so that we can unlock the savings that we know are sitting in our affordable housing properties that have had decades of underinvestment. And so we can unlock those savings, underwrite to those energy and operations and maintenance savings, so that the debt service is being paid for out of those savings. And what we're seeing in the data in Connecticut is that not only is the performance of this loan portfolio just outstanding, no delinquencies, no defaults or charge-offs, but real savings are happening, which is fantastic. We also, another gap in the market is how we think about loan size. So we'll underwrite a loan as low as $50,000 and as high as $2 million. And for those of you in the lending space, that sub-$1 million lending space is really challenging to find lenders who are willing to do that. And then our loan terms are, from 7 to out to 10 or 20 years. We do underwrite to the average useful life of the measures, another important way that we de-risk. And then we have a range of interest rates. I will say that, we believe in product strategies like this, and the need to standardize and scale over time. But I will say one of the challenges that we face in this sort of lending is the interest rate. because it's higher than a mortgage rate, and so many affordable property owners are focused on a mortgage interest rate. And so we're selling or promoting the fact that, you're paying for the debt service out of the energy savings, but it is a barrier that we all need to acknowledge that's in the market. So this loan product, which we offer at IPC now nationally, and is also offered in Connecticut through the Connecticut Green Bank and Capital for Change, we adapted this underwriting approach to work with a really exciting partner that many of you may be familiar with, Block Power. And the idea here is we took Catalyst, a standardized underwriting approach, and adapted it to the needs of Block Power's market. And we're not offering a product, we're offering a credit facility. So we're offering capital to Block Power so that they can offer a lease to their target market, starting with heat pumps, but other technologies as well. So we structured a $5 million credit facility, and their target market is really folks that don't have access to financing. These are nonprofits, affordable multifamily, small commercial, often in the urban core, that are just being left out of the financial system. Like, the choice is to do nothing and live with really outdated systems and technologies. And one of the roles that IPC played here is we were the first provider of credit facilities to Block Power. So we worked really closely with the team to build out their processes, the sort of belts and suspenders approaches a larger investor is going to want to see. So behind us, they were able to negotiate a $50 million credit facility with Goldman Sachs and kind of graduate up into a bigger class of lender. So that's another role that IPC plays, is being kind of the first in with new business models, new companies, new originators, proving it out so that these companies can scale. And hopefully we get to stay in the capital stack over the long term as well, although at a smaller slice because we're a smaller fund. And so I think I'm going to close there. But the theme for us really is creating scale through a platform, an investment platform approach that's attractive to a range of investors with different risk profiles, and allows us through partnerships to scale through aggregation and through standardization. And I'll leave it there. Thank you.
Okay, great. Thank you, Carrie. Okay, so we've got a little bit of time before this session wraps up at 12:30, and we've got several questions in the chat to go through and answer. One reminder, too, is that we will have the Zoom room open after this session wraps up for additional questions. Particularly if you'd like to sort of ask your question directly of one of the speakers or a couple of speakers, and sort of talk out sort of what you're interested in knowing more about, I think that's a really good opportunity to keep in mind. But I'll go through and hit on some of the questions that have already come in through the box. If we don't get through all of these, maybe we can come back and visit one or two of these in the Zoom room. Okay, so I'm just going to move on here. And a lot of these I think are directly directed towards specific folks. Okay, so this is a question for Candace. Candace, how was your direct financing program capitalized? And also, are there any future plans to look for other sources, maybe from DOE or some other sort of source?
Yeah, so the BAM CAP product that I first presented on was also a revolving loan product, and we've got a lot of it's been paid back. So we have a pool of funding from those loans that have been paid back, and we plan to start there. And it's not really a large amount of capital, but we hope to be able to scale. We've already been in conversations with a regional Bay Area Housing Finance Authority, who is interested in providing additional capital if we are able to show that this is something that works. So that's the plan for the future.
Okay, thanks. And then I've got another question for you. So how is your new program creating interest from property owners to engage in energy efficiency products and tenant units despite the split incentive issue?
Yeah, so we, as I briefly mentioned, we also run a rebate program. So our rebate program provides no-cost technical assistance and rebates to multifamily property owners. And through our technical assistance, we do really stress the benefits of energy efficiency upgrades. So whether they be like health of the tenants or, just improving, the quality of your building, we really try to stress those benefits. And then, once they participate in our rebate program, they are eligible for the financing program. And our financing program, we haven't settled on an interest rate yet, but we're hoping that for, the types of projects that don't pencil out, so projects that are heavy on the tenant side, and then also ones that include electrification measures, which don't pencil out in state, well, at least in our territory right now, we do plan to offer, 0-1% interest on those. So, it's not necessarily going to close the deal, but hopefully it'll get us to have a higher conversion rate with tenant measures.
Great, thanks. And I actually had one other question for you, Candace. I guess I marked it. I sort of almost cleared it off accidentally. So my apologies to the person who asked this. But did you explore pay as you save for the program at all? Did you consider that? And if so, or why not?
Yeah, so Bayron actually piloted a pay-as-you-save program in a couple of our jurisdictions, and the multifamily sector was eligible for that program, and we did complete a couple projects and offer it through our lender referral service. Based on that pilot, we decided to move forward with what we're calling the Water Upgrades Saves program, which is an on-bill finance or on-bill tariff program, and we haven't fully launched it, but we do plan to offer it to the multifamily sector and cross promote it. So, that's to come.
All right, great. And so this is a question for Rachel. And there was an interest in sort of who, you talked about energy audits, who provides the energy audits, and is there, a national list of approved providers, or does the building owner need to find their own?
Yeah, so the energy audit is generally ordered by the lender that the borrower is working with. And we've put forward, Fannie Mae, I dropped it in the chat so you can see, but a list of pre-qualified consultants who do have experience providing the high performance building report as a part of Green Rewards. So lenders can, have that list to go from. We set forth kind of our requirements for that high performance building report. It's actually included in Fannie Mae's overall property condition assessment form and requirements. So that's really what governs what is included in the high performance building report. In addition to that Excel tool that I dropped in the chat, that really lays out all the data that you need to make decisions about the efficiency improvements that are, potentially right for your particular multifamily property, so that it's very easy to, go through, a lender and a borrower and figure out what package of measures they need to select in order to meet program requirements.
Thank you. And we've got one other question for you. So what is the range of interest rate reduction for green mortgages?
Yeah, so it does differ kind of based on market conditions, but currently, we see an interest rate reduction of up to 20 basis points. So, if you're thinking of that on a $10 million loan, for example, $20 million or 20 basis point discount can mean, $20,000 in interest rate savings. And then when you factor that into the overall utility savings and the opportunity to underwrite those projected savings to get additional loan proceeds, then it can really kind of bump up the property owner's ability to finance efficiency improvements as a part of the mortgage.
All right, thank you. And we've also got a couple of questions for Carrie here. So first up on questions for Carrie. So can you describe in more detail how the second energy product is lightly secured? What is the collateral for the debt?
Sure. So the innovation here is that we are underwriting to energy savings. And so we do a UCC1 filing. We do the underwrite to the energy savings. And for solar, we're looking for a 20% cushion between the projected energy savings and the projected debt service. So we call that an energy savings coverage ratio. And that 20% cushion is, in essence, it's like a couple of months of payments. So it's a little bit of like a cushion or a de facto reserve built in based on how we're, thinking about the coverage ratio or the difference between the debt service and the projected energy savings. For efficiency, we're looking for a 30% coverage ratio. It is a bigger cushion because, as we all know, there's a little bit more variability on the energy efficiency side than there is on the solar side. And then we do, of course, look at financials and other things, even though the underwriting criteria is really based on underwriting to energy and operations and maintenance savings. But if we do see things that are of concern, we will ask for a personal or a corporate guarantee. If we see things that are of a lot of concern, then we may try to get a mortgage lien, subordinate mortgage lien to the primary mortgage. So there's flexibility built into the product, but if you're conforming, it's basically a UCC1, and we're underwriting to the energy savings, and that haircut that we're taking is essentially how we think about essentially building up a bit of a reserve.
Great. Okay. And so another question is, when does a pre-development loan get paid back if the project does not move to construction?
Yeah. It gets paid back at the earlier of moving to construction or 2 years. So this is not, this is a lending product. It's not a program that allows the loan to be written off if you don't move forward. So one of the things that we're looking for in underwriting is whether or not we think the project is going to move forward. So our team has years of experience in affordable multifamily and, are able to look at buildings to see pretty easily, okay, decades of disinvestment, really old equipment, huge opportunity here, pretty unlikely that we're not going to find energy savings. And then we're also doing a light underwrite of the borrower to gain the comfort that we believe that if, that they're going to be able to secure construction or term financing, or they have the reserves to pay for it. We did, when we initially launched the product in Connecticut way back in, I want to say 2013, 2014, we did have a forgivable loan option. And the reality is, out of all the lending we did, we only had one borrower, who asked for forgiveness, and we felt it honestly was not worth it. So we eliminated that in Connecticut, and when we spun out of the Connecticut Green Bank, similarly, we don't allow for forgiveness.
Great, thanks for giving some more information on that. And I'm going to go back to Rachel just to finish up it here. We've got one more question that came in, and I think this can potentially maybe lead into discussion we could have in the other room, but just for you, Rachel, do the Fannie Mae Green Mortgages work with utility efficiency programs? And if so, what challenges and opportunities do you see in working with those programs?
Yeah, good question. So we don't have any direct partnerships with utility programs, but we definitely encourage our multifamily borrowers to leverage utility incentives to the extent that they can, to incorporate the efficiency improvements that they've selected as a part of Green Rewards into their overall project. Because Fannie Mae's programs are set up on a national scale across, I think we have 23 lender partners now that are doing these programs. We're not able to provide guidance, around how to leverage green rewards with specific utility programs. But what we have put out is some resources for borrowers, and I can drop them in the chat, on how they would go about leveraging green rewards and looking in their local jurisdiction for utility incentives that can help them, supplement their overall project. What we do require as part of green rewards is that the borrower escrow 125% of the cost of all the improvements that they have selected to install as part of the program. Ultimately, though, we don't care how they pay for those. If they want to leverage utility incentive programs to offset that cost, then that's absolutely okay. We still do require that they include that initial upfront escrow in case they are not able to access an incentive that they thought they might have available to them. So we don't factor, possible incentives in upfront, but it's certainly something that we've tried to encourage borrowers to leverage so that they can increase kind of the overall scope of the projects that they are working on through green rewards.
All right, thanks. And like I said, I know that, really on a couple of these questions that folks have posted, I know that some of the speakers who maybe didn't respond directly to those, I know have some thoughts on a couple of topics, things like split incentives and, utilities and utility programs and lenders working together. So that's certainly something that we could potentially get into in the Zoom room. So again, thank you to all of our speakers today for their presentations, and to you all in the audience for participating in the webcast. If you would like to continue exploring the topics that we touched on today, please follow us to the Zoom chat room by clicking the Zoom widget on your screen, and we'll see you over there in just a moment. All right, thanks so much.